We've got the management of Bajaj Finance joining us on the show, Rajiv Jain Johnson. Rajiv, thanks so much for taking the time out and speaking to us. Neeraj here, good afternoon.
Good afternoon, Neeraj.
Rajiv, what's your thought of what will happen over the next 3 or 4 or 5 quarters? I heard you mention that you will be data dependent. I think what the street would want to know is that this caution or this prudence that you've exercised in Q1, is this a norm or is it difficult to say right now?
So look, from a broader medium-term outlook, not even 5 quarters, if I take a 3-year view, we remain organized to grow 25-27% in balance sheet and 20-23% net income on a sustainable basis. So that's point number 1. We also remain organized to seize growth opportunities that may represent if we continue to manage risk right. That's really what my view would be. Where we are today, we remain organized to seize the opportunity. Could it be a little slower if the current environment also persists? Maybe. But if it was to strengthen, and it could happen, it could turn around rapidly, on a full year basis, you may not even feel the difference. So I would just say, let's just wait for a little while, which is a quarter before we sign off on full year guidance.
Okay. No, I'm not asking for a full year guidance, but my question then would be that if you remain confident of growing 25-27%, in the past when you've stated this, that growth has happened without any kind of major rise in slippages or rise in provisions or rise in asset quality, worsening of asset quality. And typically, with that conservative 25-27% guidance, you've gone on and clocked in 35%, at times 40% growth. Is that under question mark? Are both those aspects under question mark right now?
I mean, core growth was 38%, so part 1, no. Part 2, if you look at this on a sequential basis, gross NPA moved up by 6 basis points, net NPA moved up by 1 basis points. Answer is no. Loan losses and provisions went up by 69%. As I was saying, in Q4 they were up 80%. The quarter prior they were up 63%. So there's no trajectory change. On a net assets to AUM, the number came in at 1.78% versus 1.45%. That number on a full year basis could change for the better or may remain same. Is it likely to deteriorate? Unlikely. I did make a point, Neeraj, that as per the new expected credit loss methodology that we follow as required by RBI from April 1 last year, there is a lot more upfront provisioning now that happens. So it flows through the P&L instead of flowing in at 90 days past due, at virtually 30 days past due. So it fundamentally then creates a stronger P&L rather than assets being booked today or income being booked today and losses follow through in future.
One of your peers also mentioned is that because this has happened in Q1, Q2, Q3 and Q4 will normalize and availability of funds is not an issue. It's never been an issue for you any which ways, but do you reckon that will happen? That asset quality, provisions, loan growth, etc. all will look normal over the next few quarters? Again, I'm not asking you to give a guidance because you want to wait for Q2, but is the market unduly worried because of what you've said you've done in Q1, which is be prudent, bring down disbursements, etc. Is the market unduly worried about that becoming the norm for the next few quarters, and are you refuting that?
No, I'm not. I'm just saying we'll remain data dependent, data driven, and let our and remain risk oriented, and but also have a growth mindset is all I'm saying.
Rajiv, good afternoon to you. Devina here. 1 or 2 quarters back, you spoke about how the granularity of the business is something that keeps you going in a big way. Talk a little bit more about that and how that has played out this quarter, and what is the focus going to shift to now?
So fundamentally, it's a very valid question. It is coming through in our in our diversified nature of the growth that our consumer B2B business, which is discretionary consumption business, grew only 24%. Our B2C business, our rural business grew 48%. Our rural B2C business grew 65%. Mortgage grew 45%. SME grew 36%. So clearly, if you look at the portfolio growth in that manner, it is seemingly clear that discretionary consumption is going through a perceptible slowing environment. But that's really where the diversified nature of our portfolio starts to play, that something goes slow at a point in time, some other portfolio picks the slack, and so on and so forth.
Yeah.
And that's really what has become evident and visible in quarter one performance for us as a company.
All right. So that exactly is the point which is of concern to most on the street, because in the past, obviously, there has been nimbleness in navigating through most of these macro events on the part of Bajaj Finance. But now as the consumer business base itself starts to grow, these macro events can pose to be a bigger challenge and pose to become a headwind for Bajaj Finance. Do you agree with that, or do you refute it?
I mean, our overall... we are only 1.15% of total credit in India. Our market share across all categories remain low. There remains tremendous headroom to grow. That's one part. Macro, and given our market share itself remains low, I am not so sure that we need to be in the center of the storm or center of a macro event. I'm not fully in agreement with the argument.
Rajiv, a word on cost of borrowing, which has been moving higher for your peers. And we asked you this question after March quarter earnings as well, when you said it's remained stable for you all in the range of 8.3 to 8.4%. I believe now for the quarter gone by, it inched marginally higher to 8.5. Do you see the cost of borrowings moving higher from the current levels now?
Actually, we have said that, so one, we were carrying a lot more liquidity, so that was part one. Part two, actually we have said as part of our commentary that incremental costs are actually going down. You know, and one would be able to see that in the bond market issuances and the CP issuances. So the information is available in public domain. If you look at our bond borrowings in the month of June to May, you would see, given GSEC also rallied, given the surplus liquidity in the system, incremental costs of borrowing is going down. But because we carried a lot more liquidity, that's why the cost has come in higher.
Also, there is some degree of seasonality in your business. You've highlighted quarter one and quarter three are relatively stronger than quarter two and quarter four. Keeping that in mind and the prudence that's been exercised for disbursement in this quarter, do you feel that quarter one may not have lived up to the expectations then, considering it is a strong quarter for a company like yours?
But a 38% core growth is a very strong growth in my mind.
Yeah.
Okay, no worries. And that just, I know you're not going to give any guidance for the time being, but in terms of loan growth for the remainder of the financial year, Rajiv, any thoughts there?
I would just say we will wait for Q2 to provide a full year guidance.
Rajiv, one question. Is the incoming data, and I know you're running short of time, so, but is the incoming data telling you to slow down materially for the next few quarters? Because it's telling your peers, some of your larger peers, forget the smaller peers which are getting beaten down any which ways, but the larger peers as well are slowing down. You've said that it's happened in quarter one. Is the incoming data telling you to slow down as we speak on the 25th of July?
Answer is no. For the month of July. I can't say that for the quarter.
Okay. One follow-up and last question from my end. Fundraising, it's a cursory question I had to ask. I reckon you're looking at a size of northwards of $1 billion. You reckon it will happen in the next quarter itself, or would it be back-ended to a second half?
We're subject to board approvals, shareholder approvals, subject to what our stance on growth is. That's really and subject to their approvals, we would go out and raise. But because we raised 700 million, I would reckon that it would be upwards of $1 billion.
Yeah, but you won't need it immediately. It's okay if you do it in the last
we are very
quarter.
comfortably placed. We are at 19.5% capital adequacy versus the required 10%, 15%.
Okay. Fair call. Rajiv, we'll leave it at that.
Thank you.
Thanks much for taking the time out and joining us and giving us that perspective.